I'm Taylor Riggs, and this is the best of Bloomberg Technology, where we bring you all of our top interviews from this week in tech. Coming up, earnings results from big tech. We bring you the latest from Apple, Amazon, Facebook, Tesla, and Microsoft. Plus, new evidence raises fears the coronavirus could spread undetected. We'll head to a biolab where researchers are working on antibodies. And TikTok has a new rival in the U.S. We'll show you the hot new video sharing app that has skyrocketed to the top of the App Store. But it is tech earnings season this week with results from the industry's biggest names. First, let's start with one of the top performing giants, Apple. Now, Apple reported its highest quarterly revenue ever thanks to strong iPhone sales. iPhone revenue was $56 billion in the holiday quarter, compared with the average analyst estimates of $51.5 billion. This looks to be the second highest ever iPhone quarterly revenue. To get perspective, Bloomberg's Paul Allen and I were joined by Forrester analyst Julie Osk and Wedbush analyst Dan Ives.
I view this as a game-changer quarter. I mean, even the bullest of bulls, thinking maybe $1.5 billion beat. This was, magnitudes of that. I think it just shows the iPhone rocket Gibraltar strong, not just domestically in China. And I think it's fueling the engine. Look at guidance. Look at the drum roll into a 5G super cycle. I think there's a stock that's going to continue to go up in terms of what we saw here. And I'd view this as a clear sort of best case scenario in terms of the quarter and guidance.
Julie, let me come to you on this then. It seems like the iPhone revenue was all that we really cared about this quarter, making sure that the cyclicality of the stock was so dependent on that iPhone revenue coming in strong. Your take?
Yes, I think that's always going to be the case when you have one product that's so dominant as part of their portfolio. And certainly the upgrades to the camera and the display always help and give it a boost, especially during the holiday season.
Julie, if we look at the iPhone, though, I mean, the revenue was very impressive for the quarter, but is this really a sustainable way forward for Apple, just ongoing incremental upgrades to its flagship product?
So I don't know if Apple would call them incremental upgrades, but I think that one of the things is as we look forward, a lot of the upgrades that you're going to see in hardware are going to appear to be incremental. There's only so far that you can go with cameras and displays. And then when you're depending on a lot of acquisitions and a lot of R&D, and you look at the fact that Apple continues to make an acquisition every 2 to 3 weeks, their spending on R&D is going up. I think we'll continue to see a lot of incremental improvements where it may be hard for the consumer to articulate specifically why they like it better. They just know that the experience is great because so many little things work so much better.
That was Julie Osk of Forrester Research and Dan Ives of Wedbush Securities. Now, Facebook earnings came out Wednesday. Total revenue up 25% year over year, which appears to be the slowest rate of growth ever. Last quarter, Facebook revenue grew 29% year over year. For more, we spoke to eMarketer analyst Deborah Aho-Williamson in Seattle.
Facebook grew its ad revenue at exactly the rate that we thought it was going to grow in 2019. So we're not worried in that respect. I mean, it's exactly where we think it is, and we're expecting continued growth next year. Everything is slowing, I think, because some of the issues that Facebook has been dealing with on a quarter after quarter basis regarding privacy and regulation, content moderation, political advertising, all of these things are still weighing on the company. But overall, I mean, I think things are still growing. And on another note, the user gains are actually ahead of where we thought they were going to be for 2019. So this is a company that is continuing to chug on and perform quarter after quarter.
You know, Deborah, every analyst on the street was really excited about Facebook in 2020 because you have the political ads, you have the Olympics, a very strong backdrop of an ad environment. Is this perhaps more of a later 2020 story when we could see a pickup in revenue then?
Well, I mean, I think we're seeing it throughout the year. I mean, our forecast only is for, we don't forecast on a quarterly basis. So we look at a year-end total, and we're thinking that Facebook's ad revenue is going to increase about 22% on a worldwide basis this year. You're exactly right. Political advertising is part of that. It's not a huge portion of Facebook's ad revenue. Certainly things like the Olympics will add a boost. But I think overall, it's the continuing gains among your everyday average advertiser who's continuing to spend on Facebook because of the accurate targeting, because the audience is still there, and because its sister property Instagram is also still growing.
Overall, these results don't look too bad, but we do have the shares down almost 7% after hours right now, and I get the sense that we're all kind of groping around to try and find some reasons for that. What's your theory?
Yeah, you know what, at eMarketer, we follow the revenue and usage for Facebook. The stock market is not something that we directly comment on. All I can say is that I really believe that Facebook has proven itself, at least according to our forecast, and it's on the revenues. It's beaten our forecast for numbers in terms of number of users this year. And this is a company where, even though it's had problem after problem, it's continuing to outperform the estimates that are put out for it. So it's hard to say exactly why the market is down at that point.
Thanks to Deborah Aho-Williamson of eMarketer. Now to Tesla, reporting better than expected revenue and the accelerated arrival of its next electric vehicle, the Model Y. Tesla's other vehicle, the Model 3, brought in over $7 billion in sales, beating analyst estimates. All of this leading the company to its second consecutive quarterly profit. That sets a pattern with first-half losses in each of the last 2 years, giving way to positive results. And a big prediction for this year, 500,000 vehicle deliveries in 2020. New Street Research's Pierre Ferragu joined us to discuss.
Well, it's fairly impressive to see that Tesla in the fourth quarter generated $1 billion of free cash flows. That's more than twice what the Wall Street was expecting, and it was still like 30% higher than what we were anticipating. And so that means Tesla can start a new factory in a quarter and keep ramping and generate that much free cash flow. So yes, there is definitely a turning point there. The second thing that I found absolutely amazing in what we've learned today is that Tesla managed to ramp a new factory with stable gross margins, adjusted gross margin in their auto division. So that means the underlying gross margin of the Model 3 have continued to expand in the fourth quarter. So Tesla is going from being like world class in terms of auto gross margins to doing even better than that, and in just 3 months.
Well, let's talk about that new factory in Shanghai, because one thing that's bound to come up in that analyst call when it gets underway in about 45 minutes' time is cost discipline, and specifically the cost of that new China plant doesn't appear to show up in the financials. So what's your opinion of that?
So as you can imagine, it's probably the one question I'll ask the team on the call in 45 minutes. What we know is that they mention the ramp of the cost of the factory, and they mention that ramp affecting their gross margin. So we know it's there in some shape or form. The one thing I can tell you is that if you look at the ramp of the Fremont factory, when the Model 3 ramped early 2017, in the first quarter, like the incremental cost getting into the numbers was in the order of $150 million. So that might be the kind of cost we have to be looking for. Now, where is it exactly in the numbers? The team is working on it.
So Pierre, what question are you asking on the call?
Well, I think we just covered probably the one that comes first to mind, which is what's the rough order of magnitude of the cost of the ramp of the Shanghai factory, so that we can evaluate the improvement in gross margin of the company, excluding that ramp, because that's what is going to give you the best indication of where the gross margin of the company is heading towards the end of this year.
That was Pierre Ferragu of New Street Research. Coming up, more on earnings. We'll take a look at Amazon's fourth quarter results next. And if you like Bloomberg News, check us out on the radio. You can listen on the Bloomberg app, Bloomberg.com, and in the U.S. on SiriusXM. This is Bloomberg. The latest to report earnings was Amazon. The e-commerce giant's slowing cloud revenue is seen to be taking a bite out of its robust holiday earnings. Amid intensifying competition from Microsoft and Alphabet, AWS is spending heavily on new data centers and hiring thousands of salespeople and engineers. For more, we spoke to CFRA analyst Tuna Amobi.
I think there were several positive takeaways in the quarter. The revenue number was above expectations and guidance. More importantly, the operating income number really blew away all analysts' consensus expectations, including ours. Even more remarkable, the fact that they were going into the holiday season really spending heavily on the one-day shipping. So that was really remarkable against those odds. And I think the Amazon Web Services business continues to at least hold its own in the face of competition from Microsoft's cloud offerings. So we know that Microsoft has been gaining market share, but I think Amazon's Web Services has gotten a lot of investors' attention in terms of the potential deceleration of growth. But I think this quarter they really answered all doubts, coming in at 34% growth in a top line and about 26.5% operating margin. So we're seeing Amazon Web Services really at the forefront of a lot of the technology and innovation. But you look at across the other areas, Prime membership group, while they don't disclose those numbers, I think you get a sense that the holiday season was actually a major catalyst for that with the one-day shipping. So a lot of positive takeaways across the board with really remarkable execution here.
Yeah, Amazon Web Services was one that was going to be watched closely. Expectations were firmly managed there, to say the least, but still surprising. What does it need to do, though, to remain competitive against Microsoft and Google without, of course, spending unsustainably?
You know, I think they're actually doing what it's within their control. I think the biggest upside for that business, as I see right now, is the international market. Some of these fast-growing emerging markets, like India, being a notable call out there. You know, obviously, I think losing the Pentagon cloud infrastructure contract to Microsoft was a big blow to AWS, you know, which they're still litigating. But that being said, I think this is a huge addressable market that will be you know, big enough for the three major players, of which, by the way, Amazon Web Services is still the dominant player in that space, despite you know, the competition from Microsoft and Google Cloud. So this is a business that I think is going to hit probably a run rate 40 billion revenue pretty soon, and you can envision AWS being a huge chunk, potentially half of the equity valuation of Amazon stock, which is why I think the milestone today of over $1 trillion really says a lot about the potential upside that we see here.
So, Tuna, I want to come and take a look at a chart then that I'm showing inside my terminal, because if you think that we're just in the early stages of what is going to be a very big market opportunity for cloud growth, why are we only growing at 33% year over year when Microsoft is at 39, 40, 60%?
That's a question we get a lot from investors. I think the simple answer here is the law of large numbers, right? AWS is several orders of magnitude the size of you know, Microsoft Cloud. So I think that really answers the question. That being said, you know, there's a lot to be said about how Microsoft Cloud Azure offering has really kind of you know, reinvented this this area. You know, they're doing a lot of things right. I think also Amazon's you know, kind of you know, quibbles with the Trump administration and the Pentagon did not help its the perception. So I think all in all, it's still you know, the market, I'd say, still in the fifth innings at best of growth. So there's a pie there that I think should serve all of these three dominant players you know, very well, especially the early movers like you know, AWS and Microsoft.
So finally, Tuna, I want you to come and take a look at another chart that I'm showing here inside my terminal. This is as of close on Thursday, so it's not yet reflecting the post-market movements. But if it were, this would be a $1 trillion company. Is that valuation justified?
You know, I think so. That's why we've kept our buy recommendation in the face of all the chatter with the you know, antitrust and government investigations. You know, so I think keep in mind this is likely to be a volatile stock in the year ahead as we head into the presidential election year with all the potential chatter about the antitrust. So this is a name that you know what you're getting into, but the core business remains intact. The shift to enterprise cloud, and you see AWS at the cutting edge of some of these innovations, whether it's machine learning or artificial intelligence. And one other data point that jumped at us: 40 million active users for Fire TV as of this past quarter. So you get a sense they're building a big ecosystem around all of these their hardware devices, Alexa and Echo, and also doesn't hurt that they just got 7 or 8 Golden Globe nominations, so they're really getting some traction in their Prime Video business with original content creation, going head to head with the likes of Netflix and Hulu.
That was CFRA analyst Tuna Amobi. And Amazon's cloud rival Microsoft reported second quarter earnings above the highest analyst estimate Wednesday, beating on both profit and sales. Cloud demand continuing to dominate. To get perspective, we spoke to analyst Glenn O'Donnell from Forrester in New York.
Microsoft is the fastest growing player in the cloud computing field. Amazon is still the big dog in the fight with its AWS cloud service. But Microsoft is coming on very strongly, a clear number 2 player behind AWS, and everybody else kind of bringing up the rear. But 62% year-over-year growth with Azure is pretty astounding, even in the world of cloud computing. And we don't see that slowing down at all for the near future.
In terms of that enormous contract that it got with the Pentagon, $10 billion, is there now an expectation that Microsoft will continue to deliver big deals like this? How much more upside is there?
I think a lot of it is derivative off of that. When you win a big deal like that, everybody wakes up and says, hey, there must be something really going on there. Let's check it out. And indeed, that has happened. And there are a number of sectors that have gone pretty strongly with Microsoft as a cloud provider. So will there be more big deals like that? We doubt that there will be gigantic deals in cloud. I mean, cloud by its very nature tends to be just a bunch of really small deals adding up. But occasionally you get something like this. And that JEDI contract with the government, $10 billion over a certain amount of time, that's a lot of money, but mostly I think it's just raised the awareness that Microsoft is a real serious player here, and indeed it is.
Glenn, personal computing revenue also coming in better. Is there something specific Microsoft is doing, or are we just in the midst of a bull market within personal computers?
Well, there's been a lot of refresh in computers lately. The older systems are slowing down, and people want to get new computers, and most of those are running Windows. So the growth there is probably attributed mostly to that. Plus, with the end of Windows 7 support, a lot of people were sort of forced into going with a new machine to support Windows 10. So that's probably part of it there.
Thanks to Glenn O'Donnell, analyst at Forrester. And later, nations around the world are taking drastic measures to stop the spread of the deadly coronavirus. We'll go inside one biotech firm where scientists are racing to create antibodies next. Plus, TikTok has a new U.S. rival, and it's a reboot of an old favorite app, Vine. We'll take a closer look at it next. This is Bloomberg. Online mattress retailer Casper is seeking an IPO valuation just over $744 million, a drop from its heyday of $1.1 billion. In a regulatory filing Monday, the startup plans to sell 8.35 million shares for $17 to $19 each. This makes its assessment short of the $1 billion needed to be a unicorn company. Founded in 2014, Casper popularized the so-called bed-in-a-box industry. I was joined by Bloomberg's Leanna Baker in New York to discuss the first closely watched IPO of the year.
It's about a 30% drop, and it's all about the timing. That $1.1 billion valuation that Casper had came in March 2019. That was before the whole WeWork debacle and the aftermarket performance of Uber and Lyft and Peloton and all these unprofitable internet-focused companies that just did not impress public market investors. So it makes sense that the advisors on this IPO are trying to tell the company, look, why don't you have a more conservative valuation to appease investors who have more scrutiny for these companies.
Is this being seen as a bellwether for future internet tech startups that are trying to go public as well?
Definitely. We're still in January, and it's going to be a long year ahead. And this is sort of that first consumer brand name that people know. We've all seen the advertisements. Casper's everywhere. And if it performs well, it could mean that companies like Postmates and DoorDash and other unprofitable names that are known by consumers and advertise a lot, they'll see whether, it's warm out there in the market for them to also go public.
So the biggest issue is everyone thinks that they have a website, and so now they're a tech company because we want the valuation of a tech company. Is this a tech company or a mattress company?
It's a great question. If you go through the IPO filing, you definitely see that it's a tech-enabled business. There is an R&D center in San Francisco, and they're trying to develop new products besides mattresses, like special lights that you put by your bedside. So the company is investing in technologies. But at the end of the day, they make mattresses and they've opened retail stores all across the country. So it really is one of those companies that's a hybrid, and it's in the eye of the beholder whether it's valued like a tech company or a consumer company. It harkens back to the meal kit craze. You might remember Blue Apron, HelloFresh, and all those companies. Were they tech companies or consumer companies? It's hard to say.
Should we be comforted by the fact that revenue grew 20% and losses only grew 5% in the same time period?
There were some highlights in the IPO filing and in its financials. It has pretty good margins in the high 40% range. So it does make money off these mattresses. Its retail locations, they say, are very profitable. So it is making money. It's just right now not able to turn a profit. And it says it may never turn a profit, which is something that's pretty common in a lot of these IPO prospectuses.
Right. Have they given us any hint that could they be profitable if they wanted to?
There's no indication, but investors might want to look at Purple, one of their rivals that went public a few years ago through a reverse merger IPO, and that company is profitable. So I'm sure that Casper would like investors to look at that just as some sort of model for them to base themselves on.
We only have about 30 seconds. Wanted to get your thoughts on another big story today. The rollback of the Volcker rule means that you can be a little bit more lenient within the venture capital world. Do you assume now more money flowing into VCs, more money flowing into startups, and creating more private, hefty, lofty valuations?
Banks have been investing in startups for a long time. This is just a new avenue for them to invest directly in venture capital funds. So it's been in the works a long time, and we'll see. But will Goldman Sachs be investing as much as SoftBank in private companies and venture capital? Probably not, but it's definitely something to watch.
That was Bloomberg's Leanna Baker. Coming up later, is the UK setting itself up for conflict by giving Huawei access to build 5G networks? We'll find out. And Bloomberg Technology is live streaming on Twitter. Check us out at Technology. Be sure to follow our global breaking news network at Quick Take on Twitter. This is Bloomberg. Welcome back to the best of Bloomberg Technology. I'm Taylor Riggs. As the coronavirus continues to spread around the world, companies are taking steps to safeguard workers from the outbreak. My colleague Paul Allen and I spoke to Dr. George Skingos from Vir Biotechnology in San Francisco Wednesday. On Thursday, we spoke to Novavax's president of R&D, Dr. Gregory Glenn. Novavax has recently initiated development of a potential vaccine.
We have a very, I think, powerful and productive platform to identify antibodies. Antibodies are proteins that circulate in your blood and protect from viral infections and can help overcome viral infections. And we're able to isolate antibodies from patients who have recovered from an infection, manufacture them, modify them a bit, and then make them available to other patients. And this technology has been quite fruitful. The earliest example, or one of the earliest examples, is an antibody against Ebola virus that's called MAB-114. Our scientists isolated that antibody in collaboration with the NIH. That antibody is now being tested in the Congo by the NIH and is showing an ability to reduce the lethality of that infection. So feel very good about that one. We have antibodies against Zika virus, dengue virus, malaria, and others.
It's very interesting that you bring up some of these Ebola, Zika. We talk a lot about SARS back in 2003. What have you learned from those viruses that can help you glean some information about this strain of coronavirus and, more importantly, how to get a vaccine out of it?
Yeah, well, we have a number of antibodies that we had isolated against SARS and also against MERS. Those are both coronaviruses. Our scientists had anticipated that it was only a matter of time until the next coronavirus outbreak. So we had already been testing those antibodies for their ability to neutralize other strains of coronavirus. Not all of them, but some of them have the ability to neutralize strains of coronavirus isolated from bats, from civets, from other animal species. And so there's a possibility that they could also neutralize the new Wuhan virus. So we are testing that possibility now with a number of our antibodies. We don't yet know the answer, but our hope is that one or more of those antibodies will be effective. If not, we are simultaneously going back and isolating new antibodies specifically against the Wuhan virus. And we are pretty confident that we'll be able to generate those antibodies. So it'll take maybe a little longer, but we'll get there one way or the other. We hope.
Given what you've learned about the coronavirus so far, what could you say about its potential for getting worse, for becoming a pandemic, or could we end up in a situation where we had like SARS, where it just eventually effectively disappeared?
Well, I think we're all hoping that it behaves like SARS and will eventually disappear. The early data suggests that it is actually considerably more infectious than SARS. Perhaps less lethal than SARS, but certainly more infectious. And I think, as your report indicated a few minutes ago, there are already more cases of patients with the Wuhan virus in China than there were with SARS, and they continue to increase. So we are hopeful that this, like many viral outbreaks, will be self-limiting, which would be great. But we are working really hard to bring our antibodies forward in case that's not the path that it follows.
Is it important to keep some perspective here during these crises as well? Because they do generate a lot of fear, but it's worth remembering that the WHO says the common flu killed well over 500,000 people per year.
I think that's a really good point. In the U.S. right now, you have a higher chance of dying from flu than from the coronavirus. Flu is can be a fatal disease for many people. It kills thousands of people in the U.S. every year. And for that reason, we have a very interesting antibody also that is capable of neutralizing all strains of influenza A that have arisen since the 1918 pandemic that we are currently testing in humans. And we hope to be able to get efficacy data even as early as this year to determine to what extent we can reduce the frequency of flu infections. It is a paradigm for what we hope to be able to do with the coronavirus as well.
Today, the CDC confirmed the first person-to-person contraction of the coronavirus. What does that tell you? What information does that give you as you work on a potential vaccine?
Well, I think, we're a vaccine company. We're local, but we think globally. The U.S. is certainly an important priority. But we know that this is transmissible. It doesn't really respect borders. It is, again, it's very much like what we see with flu every year.
How is a vaccine, why would a vaccine be better, be different than an antidote, an antibody?
Well, so that's a really good question. So, they're related, of course. The antibodies that would be scaled up and manufactured originally came from an immune response. So the antibodies, I think, are mostly going to be deployed if someone is sick. And that can be quite challenging. It's not necessarily a given that can work, So as we say in our, field, if the cows are out of the barn, it can be very difficult to get them back in. So, depending on how sick, how far into the illness someone would be, antibodies may or may not be helpful, especially for these respiratory diseases. So I think it's something that should be developed. It would be a specific measure, but it's not really clear. Whereas vaccines really have a very good track record. I used to be a pediatrician. Vaccines are almost miracles in terms of being able to prevent serious disease, and so I think that's a very desirable outcome if we could develop. And of course, our challenge is timing. Can we develop one in time, to be relevant? And I think we can, but that's going to be yet to be seen. And we're working very, very hard to see if we can achieve a good vaccine within the time frame that it could be used.
That was Dr. George Skangos of Ver Biotechnology and Dr. Gregory Glenn of Novavax. And still ahead, TikTok faces competition as iPhone fans of viral video apps turn to download a new name, BYTE, this week. Plus later, a review of all of the big tech earnings this week. This is Bloomberg. Now, UK Prime Minister Boris Johnson risks a clash with U.S. President Donald Trump after giving Huawei the green light Tuesday to help build Britain's 5G networks. It's a blow to the Trump administration, which wanted Johnson to impose a ban on the Chinese tech giant due to concerns over U.S. national security risks. Bloomberg Opinion's Alex Webb has more on the news from London.
After a year of back and forth, Britain has decided it will let Huawei supply telecoms equipment for its next generation 5G networks. Prime Minister Boris Johnson had encountered strong opposition from the US, where Huawei is already banned, and which said that the Chinese firm poses a major security risk. To assuage those fears, Johnson is imposing major limitations. The telecoms operators won't be allowed to use Huawei products in the core network, the services that direct the traffic. And in the radio access network, i.e. the antenna and base stations, Huawei will be restricted to 35% market share. It's a sensible compromise, not least because telecoms carriers were worried that the reduced competition would lead to price gouging by the remaining duopoly, that's Nokia and Ericsson. This UK approach will mean that operators can still pick from 3 main suppliers in the radio access network, which accounts for more than 3/4 of their equipment costs. It meanwhile cauterizes the most sensitive parts of the network from Huawei. Although no evidence has been presented that the Shenzhen-based company does provide backdoors for Chinese state-sponsored actors, a law was introduced in China 3 years ago that compels companies to assist the state with espionage efforts. That's what motivated US fears. This is a deal that the US should be able to get behind, in private if not in public. It's also a model for handling Huawei that the European Union looks set to follow. Thierry Breton, the Commissioner for Internal Market and Services, is expected to unveil similar guidelines to the decision in Britain.
That was Bloomberg Opinion's Alex Webb. And a new rival of TikTok has emerged, and its predecessor is no stranger to fans of video sharing apps. BYTE is created by Dom Hoffman, who also co-founded popular app Vine in 2012 and sold it to Twitter later that year. BYTE rocketed to be among the top apps in iPhone's App Store in the U.S. this week. Bloomberg Sherian and I spoke to our Bloomberg Opinion columnist Tim Colpin in New York.
That's the thing with Vine. I mean, it was only going a few months before Twitter bought it, less than a year. Twitter took it over and kind of tried to run it, but it never really quite worked out. One of the reasons it's considered that Vine was shut down by Twitter is they couldn't monetize it. The people who were running Vine at the time were a little bit opposed to running branding ads and so forth, other things. So eventually it just kind of died a slow, painful death. But it's still really strong in people's hearts and minds. A lot of people have a certain amount of nostalgia for Vine. And so CEO Dom Hoffman decided he would bring it up. It was originally called V2 when it was kind of in an alpha mode last year. It was delayed indefinitely for a while, and now it's hit the streets, so to speak, under the very interesting name of BYTE, because let's remember that TikTok, their biggest rival, the parent company, is called ByteDance. So I think that is not a coincidental name there.
Right, Tim, so talk to me more about that, because the name cannot be a coincidence. Are they trying to be a real competitor here through the name alone?
I think the very fact that we sit here in a studio and we mention the fact that they are almost the same name or very similar name, it really is the kind of thing they're looking for. They're looking for that virality. They're looking for people to remember Vine with nostalgia, but also think of TikTok and ByteDance, which is really such a strong app now around the world. It's one of those few examples of a Chinese company having a really big impact overseas, especially in North America, which is such an important market. So the naming, well, maybe it's coincidence, maybe it's not, but certainly people are talking about it. The formats between Byte and TikTok are a little bit different, but there's a lot of similarities. And so I think what we'll find is consumers will be using both at the same time, and over time they'll have a preference for one or the other, in the same way that people tended to have a preference for, say, Snap over Instagram. But the other thing that's really important to remember about the new product, Byte, is that they're trying to get some key influencers on, key content creators on. And so the battle between TikTok and Byte to try and get those key creators on will be very, very intense.
So what is Hoffman's aim here in bringing this back? Because in their community guidelines, they keep emphasizing that they have a modest budget. So what does this mean? Are they really trying to make money off this, or is this just for the nostalgia?
I think he's trying to make money off it, but he's playing on nostalgia. That'd be my guess. There is certainly that feeling of Vine was great. When it went away, people were really kind of heartbroken. But there's, it's a kind of an older demographic, basically. The people who are really big on TikTok now probably don't even remember the Vine era. Although, interestingly enough, Musical.ly, which was the predecessor to TikTok, they bought off Musical.ly. They were launched at about the same time, so actually very similar age. But in terms of the demographic of TikTok, it's pretty young.
Tim, what are the implications for TikTok here in the U.S.? We know that they're under CFIUS review. They're trying to search for a new U.S. CEO to help sort of revamp their image, not be seen as a company that's owned by another company that's based in Beijing. Is TikTok really nervous here about this new competition?
Well, it's only early days, but you know what? I think there's a counterintuitive way to look at it, and that is if TikTok comes under microscope more and more and more about being so dominant in America, having so much control over user data and so forth, they could turn around and look at Byte and say, hey, we're not the only ones in the game. There are others around, these new competitors coming along. So quite often when you look at it from a legal standpoint or from a regulatory standpoint, it actually helps to have a competitor, a solid competitor out there. Sure, maybe they'll steal a little bit of advertising money and it'll pressure them to increase rates that they pay content providers. But if they're looking at the bigger picture, the regulatory framework, I think this might actually be a good thing for ByteDance and TikTok.
Is the older demographic of, I was going to say Vine, but Byte, one of the reasons why its interface is so simple as compared to TikTok?
Well, it's too early really to know what the demographic for Byte will be. It's a very, very young app. It's basically a week old. But I would certainly say that there's probably room in that higher demographic and an older demographic. And we're talking like 25 and above is an old demographic in this space.
Right.
I do think that there is room for both. And so I think that they will probably find the demographic that works for them.
Thanks to Bloomberg Opinion's Tim Colpin. And coming up, what did we learn from all of the earnings from U.S. tech giants this week? That's our conversation next. This is Bloomberg. Wrapping up big tech's big week in reporting quarterly earnings results, one common theme across all of the analyst calls was China. Apple CEO Tim Cook said Tuesday the company has closed more stores in China as the coronavirus spreads. Tesla is also expecting a production delay in the country. For more, we spoke to Lee Drogan, CEO of Estimize.
The overall numbers are starting to get incredibly large here. But the total addressable market for basically cloud services, I think, is being completely underestimated by basically the entire market, which is why you continue to see investors chase stocks like Microsoft up here, because Azure is growing like a weed, and I just don't think that people understand how large the addressable market for all of these services are going to be. When you look at broad macroeconomic trends such as CapEx spending in the US, it is being replaced by spending on software. And what drives all that software? Cloud services.
So if the total addressable market is high, why aren't they seeing higher than 34% growth rates?
Well, at the end of the day, they are dealing with two big competitors in Google Cloud and Microsoft, which are very good products, in their own right. But as I said, that growth rate is going to match the growth rate of large productivity suite software packages. And some of those big companies are now, seeing growth rates in the 30 to 40% range year over year on the top line. Now, there are a lot of other smaller productivity software and enterprise software names that are growing 60, 70% year over year. And I do think that we're going to continue to see startups that make it big, that continue to come to market with $4, $5, $6 billion IPOs and above. We just saw Datadog, come to market with a very successful IPO. There are going to be a wave of these that continue to come out. But the really big players like Salesforce and others, these are mature-ish businesses now. But I think we can be very happy with the fact that they're still growing 20, 30% year over year.
Lee, plenty of highlights in that earnings report from Amazon, but I want to focus on perhaps one of the lowlights, and that's the international arm of the business. And I'll give you the case study here in Australia. Amazon was expected to arrive on the retail scene like Godzilla and pretty much sank without a trace. So what's the story on the international side of the business?
Yeah, the funny thing with Amazon is that from quarter to quarter, the bottom line numbers tend to really matter to investors here. But in any given quarter, it's very hard to tell exactly what they're spending money on and how much money they're going to spend, which obviously impacts that bottom line. When it comes to international, that hasn't been a massive part of the business to date, but they're going to continue to invest in all of these different attempts. And that is why, at the end of the day, Amazon continues to have long-term success, although short-term it's very hard to call those EPS and CSOI numbers, while the revenue, they basically blew out of the water again this quarter.
One-day delivery has been a big thing for Amazon. Headcount's risen. Costs for that have risen as well. Can the spending on that continue?
The market's telling you that it can, and that they're basically giving them a very long leash to spend whatever they want. Again, from quarter to quarter, I think it's important to note that the market does care about the bottom line numbers. But if you're an investor here, you're going to dig into the numbers and really prod Bezos on exactly how much he's spending on this attempt and that attempt. Because at the end of the day, he's proven that long term, he's able to make enough of these big bets into winners, even though he admits that if you're not losing big on some of these, that you're not going fast enough and you're not betting big enough. So I think the fact that some of these businesses are seeing rising costs, and obviously you see that with wage growth in the US, that is going to eat in. But they just put up a really big EPS number relative to what everybody was expecting. So hard to get on his case here.
In terms of tech exposure to the coronavirus, how does it shape up? Apple and Tesla both addressed this in their earnings calls.
Yeah, for Apple, I actually have to say, while obviously horrible that this is happening, it's better that it happens now than in about 4 or 5 months from now, when Apple will be seriously ramping up the the 5G pipeline. So better if we get it over with, better that it happened now because it won't disrupt their ability to put product into market at that point. Obviously, more broadly on a macroeconomic scale, this is going to have a significant impact, given the, how much everything is leveraged to Chinese growth, which is going to come down significantly. For Tesla, it may be a bit more acute, but we really don't know exactly